Hello, everyone, and welcome to Let's Talk Markets Live on August 21st, 2025. Thrilled to be joined by our friend Mihir Dange. He's the CEO of XCF Global. We've had him on a couple of times now. We've heard about the journey that he's been on in taking this company public, and we're going to talk a bit more about that. I mean, IPOs are red hot right now, and so we thought that'd be a good time to bring you back for a chat. On June 9th, you debuted on the Nasdaq under the ticker SAFX. And with that, XCF became the very first publicly traded pure play SAF producer in the United States. So here, wanted to check in with you, find out how it's all going. Wanted to learn more about the IPO process from someone who's been through it, and wanted to get a hold of me here before his calendar fills up with celebrity engagements. Of course, it's very glamorous to be the CEO of a publicly traded company, is my understanding. I wouldn't know. But you're going to be ringing the bell to open trading at the Nasdaq on August 25th.
That's right.
So Mihir's such a good sport. He's agreed to do an AMA. We've gotten a bunch of questions from people. So Mihir, thanks for joining us.
Well, thank you for having me. I really appreciate it. You guys do a wonderful job here. So thank you for having me. Now, I guess to kind of address what you mentioned here, the IPO market is red hot. It is now the time to. It's the time in the sense that we have been in a lull, call it, for IPO and IPOs over the last 2 or 3 years. So I think you're finding the SPAC market kind of heat up, IPOs heat up. Obviously, the type of IPOs have changed, a little bit more tech focused, AI focused, a lot of crypto types of companies out there. So we're seeing kind of like dynamically change, which is around the overall, kind of strategy of what we're seeing in the market around, you call it tech infrastructure.
Yeah.
So I think
216 IPOs as of last Friday, the
yeah,
most since 2021. I mean, that's a pretty big deal.
It's a very big deal. And I think it's saying how capital formation is operating today, which is, in one sense, private markets, private capital are are having a hard time discerning where those dollars should go.
Yeah.
So I think you'll see it heat up for a period of time, and it'll cool down afterward.
You know what's interesting, I think, that we've seen is, so you've seen the number of IPOs rising dramatically, but we're seeing the gross proceeds drop. In fact, when we looked at it in last month, it looked like it was a decline of 20% in gross proceeds, but a rise of 16% in the number of IPOs. So, do you see this as, are we seeing companies go public earlier in their life cycle, raising less money at lower valuations, or are we seeing them? I haven't looked into this, so maybe I should know the answer to the question. But or are we seeing them, offering less of the company?
I think when I look at, and maybe I have a very myopic view of what I'm seeing from my side, so I can only present that lens. From my perspective, development capital, privatized capital, venture funds, private equity funds have been in projects that are potentially locked or landlocked, and looking for directional exits. Moving it into the public market is one of the opportunities to create that directional exit. And I think you're seeing that, call it, augmented on top of the type of structure, which is, like I mentioned, AI, tech, and crypto, which allow the most opportune ways to pull that type of liquidity out. So essentially, I think private equity and our venture-backed companies that have been in projects for some period of time are trying to figure out, what do we do with this investment? Are there I have to either merge it or I need somebody to kind of roll it over into something else in order to monetize it. And from a monetization standpoint, that's potentially why you're seeing less gross proceeds.
Interesting. And so, do you think that there's is there an element of this where you have AI, private crypto companies, and the private valuations, what we have seen is, maybe to take a step back, we've seen a massive growth in the private market over the last decade plus, right? Far more, you've got all these unicorns, you've got these companies that are massive and not publicly traded. That's been a distinct phenomenon and change from markets and really the economy historically, where the original tech companies, for example, most of them went public, like Microsoft and Intel and Apple, very early on in their life cycle, right? And they were a source of massive wealth creation for people that were in on them early, but everyone had access to them. And you haven't seen that same thing recently. You've seen companies staying private, raising money from accredited investors, generally wealthier people who have access to these types of deals, and companies going public. Like Facebook was a great example. I don't remember the number off the top of my head, but it was an IPO at a massive, multi-billion-dollar valuation, where a lot of the opportunity for massive wealth creation had already gone by. Now we're in this point where crypto and AI are very highly valued, let's call it, in the private market. A lot of people probably want that exit liquidity, as you're indicating. And it seems like there's a window of opportunity in the public markets. Is there any reason to be concerned about this? I mean, I personally think it's better when more companies are public, right? It's better for transparency, it's better for access to the everyday investor, unless it's sort of public markets are just being seen as exit liquidity for a bubble that's about to burst, which I don't know. Like it's pretty hard to call when a bubble's going to burst. And in fact, just to wrap that up, on our last episode, we had Professor Didier Sornet, who specializes in predicting when bubbles exist and when they're going to burst, and has been quite successful at that. And his point was, you don't even get the same kind of bubble bursts anymore because of central bank intervention. The most you ever see markets drop now is 20%.
Mm-hmm.
But that doesn't mean for individual companies, obviously, that's the case.
Yeah, there's a lot to unpack there, but
yeah, I know.
yeah. Let me provide maybe a different perspective to it,
Okay.
which is, let's just say that there is a finite amount of money that's out there, right? Make it as big as you want, $100 trillion, right? In that finite circle, it used to be, call it in the financial world, it used to be, call it venture backed, private equity backed,
Mm-hmm.
and public trading entity. Those are kind of mainly like the three verticals that you would fit in.
Mm-hmm.
You always had entrepreneur and self-starter that you can insert that in somewhere as well. But the three main buckets, I would say, would be that in where invested capital is going in.
Mm-hmm.
Now, I think what we're seeing is you're seeing the formation of a fourth entity, right? Which is this idea of cryptocurrency.
Mm-hmm.
So you have a new layer of wealth creation or potential wealth creation that is potentially decentralized and very dynamic in the sense that it's cross-border. So if you have the evolution of, call it venture, private, public, and we're now starting to see the development of a new currency and the tightening in venture and private, right? You're seeing explosion in public and crypto.
Mm-hmm.
So if you believe that it's finite, and I don't necessarily believe it's finite, but just to make the example,
the central bank certainly doesn't, but yeah.
Yeah, exactly. But if you take the concept of that circle, that pie, which was basically a three-way pie being sliced up one by one, you've now introduced a fourth element to it, which is growing rapidly,
Hmm.
tightening potentially other two components of it.
Yeah,
So you
it's an
might
interesting
be
perspective.
you might be finding a shift out of two, or in an evolutionary path, more being bucketed towards later parts of the evolution curve.
Okay, makes sense. So let's shift gears just a bit. The last time we talked to you was on the day XCF actually went public. It's
Yeah,
been, remember, if you remember that, I'm sure it's a
that was
crazy
a
blur
blur.
now. Yeah,
That
I
was a
can only
blur. Yeah.
imagine. Yeah. So but what have the last 2 months been like for XCF and for you personally? Like, what's the post IPO life been like?
I think the one thing, like from a like, I feel like I'm learning a lot. I feel like as a CEO, there are a couple of things you always have to guide the company. You always have to have everybody kind of rowing in the same boat. Um, but you also have to be learning, right? Learning about the industry, learning from your peers, learning on how to grow the business, because essentially that's what people are buying. I think that's one thing that is like passionate for me just in general, to be able to learning about the public markets, learning about how the public markets react to things, on why things are important, um, why having our the people that work for us, they're wonderful, how they slot in, and how they're important for the growth of our organization. So I think that's one component of it. I think the other component is the public markets are not forgiving. So the rope is tight, and you have to consistently be delivering value. And I know sometimes people look at it on a quarter on quarter, trying to take a little bit more of a longer term view here.
Hmm.
I think that's something that I've learned as well. I think the last portion, which kind of brings us back to um, the previous part of this conversation, is the currency that's created with being public is an actual currency, right? That currency actually drives a lot of value. Now, at XCF, we're doing a lot of things to enhance that currency, and we think we're seeing down the road a lot of great opportunity for us. But other companies that are venture backed, that are private equity backed, we do see a lot of opportunity in working with them in order to use this currency as a way to potentially free them up and create something that is way more synergistic going forward.
Yeah. So, how does it feel? I sort of always wondered this, watching, and maybe you don't watch it too closely, but how does it feel watching the price of your stock price and watching the market, which you called it unforgiving. That's one word for it. I can only imagine, like, it must feel like it's on crack sometimes, uh, trying to understand what the heck is going on in how your stock is trading.
I think for the first month, I looked at it like I was watching it tick by tick.
Yeah.
I had it up all the time and making sure that I could see, like, oh, what does this mean and what does that mean, and I think now, a couple of months in, I have my eye on it. It's always up, it's always there. It's important. It's like an important metric that you can measure yourself by, but it's
Hmm.
also not the only metric, right?
Yeah.
Only we know what's happening at the company, and at the end of the day, it is about delivering the maximum amount of value that you can to your shareholders.
Hmm.
That no matter what the cost is, that is the number one most paramount thing here. And that's what we're always looking to do. Like, we're always looking at how we can, save money on one side, which are our costs, and how we can push revenues and push growth that can be dynamic. The mission here is to create the largest pure play SaaS company in the world. So we have our work cut out for us, but there are ways to get there, and we're starting to unlock a lot of those opportunities.
So, how I guess, the way you've characterized it now, you have this currency that opens up all these new or different opportunities. So, what are a few ways that this stage of your company's life cycle differs from where you were before you were a public company?
Yeah, I think that's a good question. I think I think when you're a private company, there's a lot of so when you're a private company, I think there's a lot of like there's a lot of we will build it and it will come. Like we're going to do X, Y, and Z.
Hmm.
Um, and people and our investors or whatever will believe you. You know, they'll believe you. They'll invest in you. They'll whatever it is. The privatized portion of this is also requires them to take a little bit more risk in order to make that investment or in order to cross the hurdle. The interesting thing about the public market is there's a direct metric to associated stock value, right? So our stock is $1.27. Our market cap is $195 million today, right? There is like a very ascertainable value. It's like, okay, well, this is what you're worth right this second, right now.
Hmm.
But there's also a lot of trust in that if I say I'm going to build it and I'm doing it, I'm abiding by SEC rules, I'm abiding by all these things.
Hmm.
And the fact that I've gone through, you know, this deep cavity search to get here is one of the trusting elements that people enjoy.
Yeah, I mean, of course, like, this is our market functions as a disclosure-based system, right? And so that's sort of this deep cavity search. What you're talking about is, you're not only uh, had everything reviewed and disclosed deeply, but as you're going forward, anytime you want to do something that's material to the stock price, right, that has to be disclosed and obviously disclosed accurately and truthfully. No
Exactly.
pressure, right?
No, no. It's important though, like, and I think that type of transparency is one that differentiates us from the private markets, and that
Yeah.
consistent transparency. Now, granted, there we are doing things that are going to continue to push the envelope going forward, but it's that the transparency portion where I think that's where it builds the currency. That's where it builds the trust. That's where it
Mhm.
builds the value.
Mhm.
And that's a value that's really hard to achieve elsewhere.
Mhm. So now that that all this work went into the process of getting XCF ready, I think if I remember, you told me you weren't sleeping much and working all kinds of hours. So now that you're the CEO of a publicly traded company, are you getting more or less sleep?
I think the I think the sleep patterns are definitely volatile. Um, I think what I've done is I've done a much better job of organization, right? Organizing time just across the board, and it's organizing time for peers and making sure that there are um, you know, regular cadence of calls with communication with the team because we're located all over the place, right?
Mhm.
We're a smaller team, but we're located in Reno, in Houston, in New York, in China, and it requires a tremendous amount of coordination.
Mm.
But I think the scheduling portion is has been paramount to that. Now, from a work perspective, I wake up and I'm basically on China time during the
Oof.
day, then I'm on East Coast, and then afternoon is West Coast, and at night back on China time. So, sleep is
Doesn't
less
sound like
important.
there's much of it.
Yeah, sleep is less important, but I'm also doing a good job of carving out time for the family and things like that. That's also equally as important.
Yes, 100%. All right, so last time we had you on, the Trump spending bill was in limbo. You were optimistic about the bill's implications for the SAF sector. So now that it's passed, how are you feeling? And did it come to pass what you had told us that there would be some pro SAF provisions in the final bill?
So I think the big losers out of the bill were solar and wind.
Hmm.
Um, the the so-called winners were probably used cooking oil as a feedstock, and SAF did better than I think some others. I think the main thing that we got out of the bill is the 45Z reduced SAF tax credit from $1.75 to $1. And that's if you were receiving the full credit. So for us, it's more of an implication of like 45 or 50 cents as opposed to 75 cents. Now, where I think it's quite impactful to like a company like ourselves and existing producers, I think a lot of people were relying on that credit in order to build greenfield projects.
Mm.
And those greenfield projects are kind of relying on some of that, call it that extra 75 cents in order to get it there. For an existing producer, I think we're actually starting to create a little bit of a moat around the production standpoint, that there's going to be less production that will come online over the next 3 or 4 years here domestically and potentially even um, in North America. I think that will only translate, call it, into the mandates a little bit longer dated, where you'll see the supply demand dynamic shift. So
Hmm.
currently, Europe has a 2% mandate. That 2% mandate is in oversupply, but it's in anticipation as that mandate grows, which it grows to 6% in 2030 and 20% in 2035. And now Norway has implemented a mandate. Japan has a 10% mandate. China's thinking about putting in another mandate. I think what you will find is this type of setup is going to be very interesting for SAF because there's a second part of this, which is you have the RVOs. And the RVOs are pushing for renewable diesel volumes in 2026, 2027.
Mm.
So SAF production facilities that were and or are RD that are thinking about converting are now going to potentially push through with RD. And I think SAF is going to be a very interesting space. I think supply demand wise will potentially be upside down, and I wonder how that space is going to continue to grow. So I would say the bill itself is probably a small loss for SAF producers, especially potential producers. But for an existing producer, it could potentially be a big win because there's going to be less production that comes online.
Okay. And do you see yourselves sort of getting involved in the renewable diesel space too?
So currently, yes, I do. And so currently we are producing renewable diesel.
Okay.
And the intention is to produce renewable diesel up until, call it, the last quarter of the year before we shift over to SAF.
Okay.
So I think what makes us a tiny bit different is renewable diesel economics have come back up. So I think you'll find that the renewable diesel providers will continue to produce renewable diesel. And I think as we're currently in an oversupply that changes over 3 or 4 years, I think what you'll find is what's better over this 3 to 4 year period is more of a staging plan on SAF, which is we're going to stage out 3,000 barrels a day in 2026. And in 2027, we're going to get ourselves to 7,000 barrels a day. In 2028, we'll get ourselves to 10, 15, 20,000 barrels a day. I think that staging plan is going to be more important so that it paces with the industry as opposed to hitting all of it right up front.
Okay, so did the way the bill ended up coming out, has that changed your sort of strategy and approach here, or was that end of year cutover always going to be there? And does that mean that there's no longer, you're no longer going to be doing the renewable diesel?
So our intention was to be SAF all along. I think what we started to realize is that as we are bringing this facility up, it's not as easy as turning a light switch on. There is a lot of chemistry and infrastructure that's here, and there are things that kind of ebb and flow in between. So one of our options was so we produced SAF, and we're still trying to explore how we're optimizing those netbacks. And the netbacks around them they differ. It's a very nuanced type of space because there's this idea of credits in various different states. You have California has a different credit, Illinois has a different credit, Minnesota has its own credit, so that's its own nuance, right? And then there's, call it California and Oregon and whatnot, they participate in the LCFS. So those are its own credit structure. Then you have the Jet A plus green premium, which is your SAF green premium, which is comprised of your scope 1s and 3s. So that has its own own variable in there. And all these variables are coming together still in real time because this mandate was only put in, call it in Europe and in other places over the course of the last 8 months. So one of our options was, and as we're call it bringing this the plant, it's coming up and down, so that we're optimizing and getting it to full optimization at the end of the year. So one option was we produce the SAF and keep working around like how we're going to optimize the netbacks with our existing distributor. And some of the economics were looking favorable in some places, some of the economics were not looking. And so a very consistent, call it, way to operate in between was to create renewable diesel, right? Have some renewable diesel production until we can create more of a growth curve out of the SAF itself. So yeah, a little bit of a pivot, but not so much to the overall strategy, just making sure that we get everything operable and functioning, because I think, call it the beginning of next year, what's going to be super important is what does everything look like? What does your throughput look like? What does your your SAF rates look like of your SAF, your light ends? So that's kind of where we stand today. I'm not terribly worried about it.
Okay, so I do want to dig just into one of the things you were talking about there. So, in terms of California and Illinois, I know that Platts, which is part of S&P Global Commodity Insights, launched these 4 daily market-based California and Illinois sustainable aviation fuel assessments that exclude environmental credits. Just launched, right? Like this week, Monday, they launched these, and the fuel buyers. This is what they want because they exclude these environmental credits. So can you tell us a bit more about this and what it means for XCF?
Yeah, I think what the market is missing is this transparency, right? I think we take any kind of oil and gas industry right now, whether it's crude or jet A, heating oil, bean oil, all these very consistent products, refined, all refined related, RD, they all have a very consistent market. And they have a very consistent market because the output is like a singular output. You produce renewable diesel, you move it over, you potentially collect a credit. That's a state and a government credit, right? So those credits live independently of your low CI fuel. What makes SAF kind of unique is those parameters exist as well, but there are credits that are embedded in the actual value of your SAF, right? The value of your SAF is without those credits, it's just basically Jet A, right? So we know how to price Jet A, but there is this idea that we're reducing the carbon intensity in the world by creating it from a vegetable oil or this whatever the feedstock is, which is a lower carbon feedstock, which gets us here. But there is no way to actually put a value on it,
Mm-hmm.
right? So there is no value on SAF today because it's very difficult to ascertain the value between buyer and seller. And embedded in those credits is your scope ones and your scope threes, and the scope ones are the ones that are used by the airlines, which are actually the people sitting in the seats, and the scope threes are used by your call it the companies that are putting those people in those seats,
Mm-hmm.
right? Their corporates, their executives into those seats. So again, you now start taking the entire value chain here, and you have the production of this low CI fuel, which now has an embedded value with credits in it. But how do I value that?
Mm-hmm.
Right? How do I create some? How do I understand what that is? There is no market around it, and that's why I think Platts is trying to make a push to say, this is how we derive the value around this. This is how we try and create a very structured product in SAF.
So how, I mean, I'm a markets guy, so I'm sort of very interested in this. Like, what is the market pricing mechanism here? Like, where do they get that value from that they can't get it from today?
Yeah, so it is. It feels like a lot of work and what we used to do, right? So when I did open outcry in the markets, it
Mm-hmm.
was what a buyer was willing to pay and a seller was willing to sell, and then eventually got posted somewhere. Similarly, we're kind of in the early stages of SAF where it's what is a airline willing to buy, a wholesaler, what are they willing to pay for this SAF, and what are and how much of it they can offset. So typically what's happening, and this is just the overall,
Mm-hmm.
an airline is buying sustainable aviation fuel, and they're buying it on a blended basis because it's blended, call it 70% with Jet A and 30% with SAF. So it reduces the carbon intensity of that overall flight. Now, when you throw the mandate in there, they have to meet that, whatever the mandate is over the course of the year, using that, call it, let's just use the 30% there. And then they're using the scope ones for themselves, and then they're selling off the scope threes in order to reduce their exposure to the higher cost of SAF,
Okay.
right? And that's typically like how the functioning works. So you might find, and then you layer into that some states are giving credits and some states are not. So California, for our product, for example, can give a 55-cent credit back to the producer,
Mm-hmm.
right? And depending on the carbon intensity, you can improve that or uh, increase or decrease that.
Okay.
In Illinois provides a $1.50 credit to the airline if they purchase it,
Mm-hmm. Okay.
right? So quickly, it's really what is a buyer willing to pay versus a seller willing to sell. Now,
Illinois, their buyers are willing to pay more because they're getting the reimbursement,
right,
but in California, producers are willing to sell it cheaper because they're getting the rebate. Is that
right, exactly.
okay?
Right. So that's the crux of it. And it depends on what airlines you're dealing with. Some airlines are saying, well, we don't want to pay more because we're trying to get our costs down to Jet A. We want to hit parity as quickly as possible.
Okay. Yeah.
So this is where, there is no standardized market, right? There is no standardization around this product. It is what is truly a buyer is willing to pay and a seller willing to sell.
Got it. Okay. So now that's why these assessments sound useful because it can disentangle all of that and get to that sort of end price of what was actually paid economically.
Yeah, potentially. Potentially, it's trying to at least drive more value on what the rough parameters of the value of SAF are today.
Got it. Okay. Another question that came in, you've called XCF the first pure play SAF company. Can you clarify like what does that mean in pure play? I mean, I think maybe it's obvious what pure play means, but like how does that differ relative to other companies?
Yeah, so I think today when we think of low carbon fuels, in the low carbon fuels market, we have not seen a publicly, so there are companies that produce SAF,
Mhm.
or those there are companies that produce renewable diesel, there are companies that produce both. Going like we have not seen a company that has come to market that is pushing that wants to be just a SAF production company, right? Where their singular focus is we want to produce SAF and the maximum amount of SAF going forward. And the reason I say that is there are companies out there that do a lot of things, right?
Mhm.
There are publicly traded companies that do a combination of both of these things.
Are
The
these like
idea,
big household name companies, or are they or are they smaller niche
I
players?
mean, there are only a slew of publicly traded companies that do this, right? So you have Neste, Darling does feedstocks, but they also have some SAF there. You have Calumet, which is RD and SAF, and then you have Gevo. Gevo does ATJ SAF. You might be able to call them a pure play. I don't know what their pipeline of growth looks like. And then you have LanzaTech and LanzaJet, right? So, and LanzaTech does more than just call it the SAF portion there. The way that I'm looking at SAF going forward is SAF is its own CI vertical. Is
Mhm.
that with the mandates that are coming in, the requirement to meet SAF on a molecular level, which is in Japan, you need to meet 10% of the molecule going into the wing of the plane.
Mhm.
Eventually, in Europe, it'll be 20%, which goes up to 70% in 2050. So, in terms of investable class, currently there isn't like if I wanted to invest in SAF, who am I investing in? How am I getting full
Okay,
exposure
got
to
it.
that?
Yeah,
And that's what we're trying to fulfill.
great. Okay, makes sense. All right. Uh, Switching again, next Monday, you're going to be ringing the opening bell for Nasdaq. That's super cool. How how do you feel about that?
Thank you. Thank you. Actually, I am so sorry. I should have invited you, but are you available to come and join us? It'd be great if you guys could come and join us on
Oh,
Monday.
I'm not going to speak for him. I'm away next week, but maybe Alex could come up from
Okay.
DC. I will definitely see if I'm sure he
Yeah.
would be thrilled to do that.
I
That's
think that's
cool.
a I
Thank you.
think that would
Thank
be
you for
a
the
good
invite.
idea.
Yeah.
Yeah, so we're ringing the bell. It has taken us a little bit of time to get the date. The Nasdaq is, y- slammed with IPOs.
Yeah.
It's a very, it's a it obviously the IPO market is starting to flourish, but for us, it's just, it's a way to commemorate being public, showing some appreciation to our shareholders and all the people that have been a part of this journey, from board of directors to employees. Um, and that'll be Monday morning, and then we're back to work.
And then again, like another big market event, and then back to work,
Yeah,
right?
exactly. Exactly.
All right, we got one funny question. So, do you see a distant future of using SAF for space fuel?
I have been reaching out to some of those companies, and I do think it is a very viable opportunity. I
Oh,
I
cool.
think I think what we're gonna find is at some point, right? I think at some point in the future, we're really going to be okay. We're in the AI, and my personal opinion is we're in the AI, crypto, call it tech era.
Mhm.
Um, the future is really focused around the infrastructure around these things. Infrastructure is going to be deeply, deeply important, and so is specialized labor. So in that, call it infrastructure, we think anything that supports that low CI endeavor will be important. So I think rockets are going to be one of them. Airplanes, obviously, the other. Um,
Mhm.
Sorry, long-winded answer to a
Yeah,
easy
no,
question.
that's cool. And I mean, I'm also sort of curious as airplane technology advances and maybe they get faster. Um, I imagine it, unless there's a pretty like fundamental shift, they'll still be fueled in the same general way, and then SAF still fits into that regardless.
Yeah, I think that's right. I've looked at a lot of studies on where we think the advent of the plane potentially outweighs the fuel,
Hmm.
and it still feels like it's most of the things that I've read are about 25 years from now.
Yeah.
I think we're quite a ways from there. I think you'll find that for like everything that's small haul, eVTOL, light battery will suffice.
Hmm.
But for anything mid to long range, the only way to really decarbonize will come through SAF. So I think you'll find innovation will actually come within the SAF space.
Hmm.
Innovation will happen around feedstocks, around I think it'll be around feedstocks, technology, pathway. Those will be the things that'll actually drive the growth, I think, because the idea is that we get to Jet A parity over, some period of time. That Jet A parity will allow us to keep the existing plane the way it is.
Okay. So let's go back for a second to investor engagement now as a public company CEO. Uh, where how has that been? I mean, it's only been it's been a short time that you've been public, but still, have you seen an interest out there in engagement from both retail and institutional investors? Obviously, we're working to build out your verified shareholder community and to bring in, we're seeing that nice trickle of retail investors coming on and finding out about you guys or, joining the community after purchasing shares. But, where do you see that level of engagement sort of going forward with both retail and institutional investors?
I see. I think just watching our stock and understanding, call it the markets, which I've studied for now for a long period of time. It it feels like institutions want to wait and watch and understand what does this stock, this company, this management team look like going forward.
Hmm. Hmm.
Um, so so they want to understand, evaluate, spend time in doing the research with you, your competitors, your profitability, look at the metrics, right? And what we do is we try and benchmark all of those so that we're trying to stay consistent with them. That's the institutional way, but once institutions get involved, they're going to stay in for a long period of time,
Hmm.
right? So they do a lot of research, they want to be in. The retail community is, I think they will come in first, and they're more your market setters, right?
Hmm.
So they will come and they have the opportunity to set the market, I think, before the institutions get involved. And then I think in sometimes they have a little bit more of a shorter duration than long duration. But I think the retail community actually has a lot more impact on a stock than the institutions.
Mm.
Because the retail community is very responsive, right? You put out news and the retail community responds.
Yeah.
You do things and the retail community will really, you know, uh, support you or not support you.
Hmm.
And so, like for example, we're trading where we're trading, but if the retail community sees things that they like, right, they ascertain more value to us. That doesn't change the institutional view of whether they're buying us here or they're buying us higher,
Hmm.
right? They're just taking the view that we want a long-term bet on the company.
Right.
So retail actually has a lot of driving force in shaping, the called the early part of I think a company.
Yeah, no, I think that's right. It's really been incredible to watch it because I think if you go back to like COVID and the stimulus checks and the sort of wave of retail involvement in markets at that time, a lot of people thought that that was going to be just sort of a temporary or transient phenomenon. And that's not at all what we've seen, right? We've seen the continual increase of retail involvement and retail presence in markets. And I think you're right, especially with smaller, and let's call it niche companies. It does feel like retail is much more willing to take a chance.
Yeah.
And sort of like what I was talking about before, like they're looking for the company that's really going to help them with wealth creation, right? And sure, like a lot of them are investing in indexes or large cap steady companies, but they're still all out there looking for that next big one, and open to taking risks and taking a chance.
Yeah, they absolutely are, right? They are the benchmark for setting the risk profile, and like you got to give them a lot of credit because they're the ones who are willing to take more of that risk up front, and so they should be rewarded for that. And
That's right.
in those power scenarios, which I love seeing, are the ones where they take control over the institution. They
Mm,
put the institutions on the defensive.
yeah,
I
that's
love
right.
I love that opportunity.
We do. We love that. We love to see
Yeah.
that too. And hopefully, we're going to see that with you guys, and hopefully also through a combination of both, you guys building a great company and our technology that helps you bring together your actual shareholders in a community where you can engage them and inform them better than what we generally see on social media.
Yeah, we do too. We really respectful of all the things they've done and the shareholder community. They're great. Absolutely great.
Yeah, awesome. Well, here again, thanks for coming on. Really appreciate it. I think we covered a lot of ground. We got some good questions, and we really appreciate you going deep into SAF, and then also like what it's like to run a public company and then ring the bell of the Nasdaq. Very cool.
Well, I really appreciate it, Dave. Happy to do this again. I really love hanging out here and giving
Yeah.
you just a small world view of what we're going through.
Yeah, no, I think it's really unique. We're really excited to give that perspective to retail investors who would never normally get to see this. So, very much appreciate that. We'll definitely have you back on. And hope everyone can join us. Then, make sure to subscribe and like the video if you're watching on YouTube. Follow us on different social networks so you can get us the next time Mihir is on. As well, next week. We're going to be off again. Last week of summer, got to say, we're going to take a little time off, but we're going to be back. I think the next show that we have scheduled so far is Wednesday, September 10th. We're going to be talking markets with Dennis and George, and then September 17th, we're going to have our macro markets team on to talk more interesting Fed observations and what's going on in markets. But until then. Everyone have a great end of the summer. Mihir, thanks again and really appreciate it.
Really appreciate it. Thank you guys so much.
All right, thanks.